Hello, Michael. Hello, everybody. Here with Michael Plax, the real estate tax black belt. Actually, there's something wrong with. As we keep going, I just on the wrong slide. Taxes for flippers, taxes flippers. Okay.
Let's
Welcome.
restart. Let's do 1, 2, 3 one more time. Okay.
Yes. 1, 2, 3. Welcome, everybody. Here again with Michael Plax, real estate tax black belt. I'm Bernard Reese. Today's topic is number 14 in our series of real estate tax write-offs, and it is taxes for flippers. As is always the case in this wonderful series, we're going to cycle through benefits, gotchas, and execution with regard to taxes for flippers. Michael, can you take it away and lead off?
Yes, I will.
What are the tax benefits?
Yes, and Bernard, can you do me a favor and for a second bring back the previous slide? Okay, so the previous slide says on the benefits, no tax benefits. Sorry. Okay, when we had two previous episodes that were devoted to specific strategies of real estate investing. We had one episode talking about tax write-offs for wholesalers and realtors. We had another one for landlords. And right now is the third last one in that separation of different venues of investing is for flippers. And why did we save it for the last? It's basically because we didn't want to bring bad news earlier. And this is not an episode that squarely fits into our topic of write-offs, because what are the write-offs? Benefits says, sorry, no tax benefits. And to explain that, what we're going to do is I want to start by clarifying what actually is flipping. Also, since there are no benefits and I cannot really punch Uncle Sam for flippers, I'll take off my gloves. Okay, so no red gloves.
So I would say I don't want to make it all doom and gloom. There are, of course, all the regular tax deductions and strategies that are available to most businesses.
Yes.
It's the real estate unique tax benefits that are not available.
Correct. Yes. And all of these things that we talked about that apply to wholesalers and realtors do apply to flippers as well. But I need to first define what exactly are we talking about when we refer to flipping, because this is surprisingly confusing. People often ask me, reach out to my firm and saying, "Is this okay? I flipped a property." When we start getting more information, turns out is that they bought a property, they rehabbed that, put a tenant there, and then sold. No, this is not a flip. Flip does one thing only. You buy property, fix it, and get rid of that immediately. So flipping generates money from one thing only, from you improving that property. Well, or sometimes if you flip without improving, it's just a difference in price. Okay, you buy it very low, sell it very high, but there are no tenants in between. This is the key part of flipping. So when we are talking about flipping again, this is a property that you bought, fixed, and trying to sell for maximum profit right away. And when we said that there are no benefits, and our slide keeps repeating that, well, the benefit is you do make money, right? That's an excellent way to generate money and capital to buy properties that you hold after that, to buy your passive investments, to buy your rentals, buy your STRs, buy your syndications, whatever it is. Yes, it's excellent way to generate money, but tax benefits are not there. Let's remember, what did we talk about when we discussed benefits in the context of landlording? We talk about preferential rates for profits on capital gains. We talk about deferring those capital gains through 1031 exchanges. We talked about depreciation deduction. We talked about cost segregation. Guess what? None of that applies to flips. You don't have depreciation. You don't have cost segregation, which is basically a form of depreciation, like accelerating depreciation. You don't have capital gains. They do not apply to flips. And since you don't have capital gains, you don't have a way to defer capital gains. That is 1031 exchange. This is very important to remember that what we talked in the previous episode about, the one before was about 1031 exchange, it does not apply to flips. That's a very frequent question consistently asked of all CPAs and tax accountants. Where asked is, okay, I just sold my flip. How can I defer taxes on that? You cannot. All of those techniques are for rentals. If you sold flips, a flip successfully, congratulations. But Uncle Sam is breathing down your neck and waiting for you to pay. Pay what? Not your capital gain rate again. You don't have those beneficial rates. It's your regular rate, whatever that is, whatever your tax bracket is at the time. So if you are very low on the tax bracket rate, it could be low. It could be 12%. Okay. If you're very high, it could be over 30%. Then on top of that, if your state has income tax for on the state level, you add a few percentage points for your state tax. But what almost everybody overlooks is the gotchas. So what is that gotchas, Bernard? Explain it.
Yes. With the case of flipping, in which you're not treated as having sold a capital asset, but rather as having sold something more akin to inventory. So it's more like a regular business form of income, which will generate self-employment tax. Self-employment tax, we've rounded it on the slide to about 15%. It's a little higher than that, but it can be a nice chunk of change because it means on top of whatever your ordinary income tax rate is, there's an additional 15% self-employment tax.
I would disagree with you, Bernard. You said it's a nice chunk of. It would be nice if it was coming into my pocket, but in this case, it's coming out of my pocket into his. So there is nothing nice about that.
Absolutely. And that really brings home, again, the distinction between a flipping business and a long-term rental investment strategy. A business, trader business, activity generates self-employment income, whereas holding assets for appreciation does not. So the big gotcha is going to be 15% self-employment tax. And
we don't have time or even desire, frankly, to go into the technicalities of that issue. But what Bernard and I are talking about on this episode is very well known in the investment circle as the dealer issue. And there is a lot of technical detail there and a lot of nuance which sometimes may allow you out of that 15% self-employment tax, but that's way outside of our ability to describe these topics in a short episode. So absolutely talk to your own tax advisor, figure out if in your case dealer issue applies, but for the purpose of our episode, if you are consistently doing multiple flips, and there is a misconception or very popular online in podcasts, blogs, and so on, that says, oh, if you only do fewer than, whatever people say, fewer than 5 flips, or if you only did 2 flips, then you are not a dealer. There is no such thing as a number of properties. It's a very case-by-case situation. So yes, sometimes you may be able to avoid it, but most flippers cannot, and they would be in that gotcha situation. And the most dangerous thing about that, which in my 30 years of practice as a tax accountants specializing in real estate I have seen, unfortunately, way too many times, is that tax liability, and it's huge. Again, let's review what we talked about. It could be your regular rate, which could be as high as 30%. It could be plus your state rate, let's say at 5%. So here we have 35. And then we might have self-employment tax. If you do the math quickly, it almost comes to half, almost comes to 50%. Half of the profit goes to your silent, nasty partner who is standing right behind that, smiling behind that mask because he's getting half of your profit without doing anything to help you make it. Yes, it's disgusting. Yes, it's awful, but that's how it works. And what happens is, if you are doing well in flipping and you are generating all of this money after, of course, taking all of the available deduction. We had an episode about deducting your business use of your vehicle. We talked about all of these different things. We will have an episode where we will specifically talk about self-directed retirement plans, but there are retirement plans that you can use to mitigate that. So all of these things, even after you applied that, if you do well, there is a significant profit and there is a significant tax. So if you have W-2 job, what happens? How do you handle tax? Well, it's taken out of your paycheck, but nobody's taking money from closing. Title company is not withholding taxes from you. So all of that accumulates. Then April comes of the next year. You go to your accountant calculates it and says, okay, you have to write a 20,000 check to the IRS. And then you have, oh my God, I don't have that kind of money. Everything I have is deployed in new properties. Oh, well, when I sell next property, I will pay that. Never happens in my practice. What happens is you have that bill, you continue making more money next year, and the problem gets worse. So unless you have a plan and you budget for your taxes, which is one part of our execution, we have a two-part execution. So my first part is make sure that if you are only doing flipping and no other strategies, then your tax bill is probably going to be significant, and you need to prepare for that set money aside for taxes. Otherwise, it will be a black hole into which your business might collapse. The second part of the execution, Bernard, what is it?
So the second part of the execution brings us back to the fundamental that flipping is effectively a business. And
that's a good part in this case.
Yes, this is the good side of it, which makes business tax deductions available. It's earned income, it's ordinary income, which means you can use retirement accounts to create tax deductions. And some of those retirement accounts can create deductions of $60,000. Some can create hundreds of thousands of dollars per year in tax deductions, depending on your overall tax profile. And those are not available to those that are strictly investing in long-term real estate. But if you have a flipping component of your business that generates ordinary earned income, you may be able to mitigate that using tax sheltered retirement accounts to create tens of thousands to hundreds of thousands of dollars of tax deductions. And for our audience, which are real estate investors, that money can be invested in real estate opportunities. It does not have to go towards the stock market or hand it over to a financial advisor.
And I want to close this episode by reminding everybody that Bernard is the founder of Resura Financial, the company that specializes, among other things, in retirement plans. So all of your questions, please reach out to Bernard. He is an expert in mitigating tax liability, particularly for people like successful flippers who have a large opportunity to mitigate tax through retirement planning. So see you guys on the next episode. On the next episode, we are going to address LLCs and partnerships. Thank you, everybody, for listening. Thank you, Bernard, for helping.
Thank you, Michael. Thanks all. See you in the next episode.